Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And suddenly, the end of the first quarter.
Yeah, it's been a good quarter for equity investors. S&P up 9.5%.
All-time highs on the benchmarks. A great quarter, too, for the ETF market. So let's get to the biggest stories right now in the more than $12 trillion global ETF industry. And we start with Morgan Stanley's ETF lineup officially breaking $1 billion. That's after the firm's first ever mutual fund conversions. In just a bit, we'll be speaking to the global head of ETFs, Anthony Rochte.
When the Bank of Japan raised rates for the first time in 17 years, it also stopped buying ETFs. So what happens to the central bank's $475 billion hoard of funds?
And we have a birthday in the house, and that is because it's been 25 years of QQQ. And we're celebrating the quarter-of-a-century anniversary with Ryan McCormack of Invesco. But before we get there, as always, Eric Balchunas from Bloomberg Intelligence. He's here with us now. He's looking at the flows. Eric, what do you got?
Katie, Scarlett, you talk about the end of the quarter. Perfect time to look and take a step back, I think. Plus, the weekly flows have a lot of tax rebalancing, so they're kind of messing up the data. So let's look at the year-to-date flows. Where do we stand? 168 billion total. I'll go over that in context in a minute. But look at the top of the leaderboard. VU, IVV, and VTI, all U.S. stock ETFs. They continue to see a ton of inflows. Number 2 is IBIT. Number 4 is FBTC. Those are 2 Bitcoin ETFs. Crazy that anything new is anywhere near the top 10, let alone 2 and 5. That's been a big story. Also the Qs, as we just talked about. Later on the show, we'll talk about the Qs. SPLG, another S&P 500 ETF. I'm also interested here in EMXC. Emerging markets haven't done well, but people love emerging markets ex-China. That is the best-selling EM ETF for the past 2 years, basically. And then you have some ESG ETFs on the outflows, which we'll look at right now. So when we look at the outflows, you can have ESG on there. You're also going to see SPY. Now, SPY on the outflow leaderboard, a lot of this is money that came in December for tax loss harvesting that has come out. So I wouldn't call that sentimental so much. GBTC is this massive unlock, right? When it converted, a lot of legal issues, people got out of there. The fee is higher, so you have outflows there. IWM is the most interesting here. IWM, small caps are people keep betting on them to have a regime change, and it just doesn't happen. And people go in, and then it doesn't happen, they leave. And that's sort of been the story with small caps and many other areas in the market. So let's look at that sort of total number of 168 billion. I want to break it down by equities and fixed income. So you can see here, this is fixed income and this is equities. Equities typically take in about 2 or 3 times more than fixed income. That's normal. So again, our theme this year is comfortably bullish. We go back to something like 2023, you can see more comfort there. Now 2022, is a horrible year. See how fixed income almost matches? And then we go to 2020, you see fixed income is even greater. That's bad. 2021, equities 10 times more than fixed income.
Home on Staten.
So I think in context here, this does stick with our theme of comfortably bullish. Again, not quite euphoric, but everybody just keeps routinely putting in money into the S&P 500.
All right, comfortably bullish. It is good enough for all-time highs. Eric, thank you. Joining our conversation now, I'm pleased to say we have Anthony Rochte. He is global head of ETFs over at Morgan Stanley Investment Management. Of course, Morgan Stanley making waves today with your first ever mutual fund conversions. That birthed, of course, the Eaton Vance Total Return Bond ETF and a short duration Muni ETF as well. And you told me over the phone a little bit earlier, of course, that you thought long and hard about which mutual funds you're actually going to convert. So walk us through why these 2.
Yeah, good afternoon. Good to see you. Yeah, we've been very clear and intentional about building out a multi-brand platform. Brands like Parametric, Eaton Vance, certainly Calvert. We evaluated the ability to convert a couple of mutual funds to an on-exchange ETF. And with the growth of fixed income investing, it looked like an obvious choice. We've seen an acceleration of what I call the equitization of bonds, this idea that investors can buy ETFs or can buy fixed income through an ETF, and so it seemed like a logical choice. We will continue to evaluate, Katie, conversions, but we'll also launch organic net new ETFs as well. And we launched our 12 ETFs in 12 months, and we're excited to say we just went through $1 billion in total assets.
So let's talk about the new organic launches that you are thinking about at the moment. What asset classes, are they all going to be active or will some be passive? What's the likelihood you'll include options in those 2?
Yeah, so to answer the question directly, we're very focused on active ETF, given it's our heritage and how we manage money. So active is a focus, fixed income is a focus, and we actually already launched 2 option overlay ETFs from Parametric in late October. The Parametric Hedged Equity, ticker PHEQ, and the Parametric Equity Premium Income, ticker PAPI. So the option overlay business, as you know, it's grown 6-fold in the last 5 years, so it's a fast-growing category, provides income and downside protection on the equity side.
And, you know, I've known you back from the State Street days. You're like an ETF person that went to help other firms start their ETF business, like at Fidelity, now at Morgan Stanley. I've seen people have different types. The management is very liberal or not that liberal in terms of launching products. What's it like inside Morgan Stanley trying to get some of these products and these managers to launch ETFs into the marketplace?
Well, start with the clients, and work backwards. We've seen insatiable demand for income, certainly active ETFs and fixed income, as I mentioned earlier. We've also seen interest from portfolio managers themselves who run SMAs and mutual funds and want to extend the choice to the ETF wrapper. So again, we've launched our 14th ETF in just over a year, and so we've gotten great support internally. But I would say, back to your question, active management is at the core of how we manage money.
Well, to what you're saying about SMAs, it's interesting. It's not just Morgan Stanley hitting the tape today. You also have Eagle Capital Management launching a new ETF. And a lot of the assets that they're starting with are SMA converts. So definitely a migration, a continued migration into the ETF wrapper. But Tony, a theme that I'm kind of obsessed with is the idea that it's easier than ever to launch an ETF, but it's harder than ever to gather assets in that ETF, given how competitive this marketplace is. And with that in mind, I mean, what does your distribution game have to look like? How much focus are you putting on that?
Yeah, there's no question working with the product team is critical. The PM's important, but you have to have distribution across the intermediary channel, which is financial advisors, registered investment advisors, but also we've seen demand out of the gate for institutional clients. So it's both intermediary focus and institutional. But Katie, we work backwards. We start with where is their interest, where is their demand. There's an insatiable appetite for income and yield in this environment, and that's really driven some of the new active products we've launched.
And in part of marketing and distributing these different ETFs, can you talk a little bit about the brands that you do them under, whether it's Parametric or Calvert or Eaton Vance, and what's the shorthand for what each of these brands signal to potential investors?
Yeah, so Morgan Stanley Investment Management launched a platform, right? And we leverage the multi-brand approach. So Calvert, for example, 40-year history and a pioneer in ESG investing. Parametric is known for customization, and they've had an option overlay business for almost 2 decades, delivering solutions for institutional investors. And Eaton Vance, certainly a leader in active fixed income. So that's really where we're focused, is where's the strength of the brand? How can we make an on-exchange ETF available?
And let's talk about your lineup. You've got some hits. The floating rate in particular looks like a nice organic hit. ESG ETFs, you have some assets in those, but let's face it, that sort of hits some headwinds. You see some of them in the outflows. A lot of firms are actually removing ESG from the name of the fund. How do you get that going again? How do you rebound from the sort of bad returns in 2022 and the political baggage to get ESG ETFs interested with advisors?
Yeah, specific to ETF in the U.S., we're very focused on that through the Calvert brand. They've done it for over 40 years, Eric, so they know that space, but we let the investors choose. I think your comment around Eaton Vance and the floating rate ETF, ticker EVLN, we launched that in early February. It's over 65 million, and right at the beginning of March, it had over a 9% yield. So again, whether it's option overlay, income focused, or yield through floating rate, those are really where investors are focused.
And just really quickly, we don't have that much time left, but you mentioned this demand for income, this demand for yield, and I found that really interesting because it made sense in 2022 when the public equity market was really going through it, but now you're at all-time highs, and there's still this demand for income. Where is that coming from?
Yeah, I think, look, a money market at 5%, people are getting very used to these type of yields. Now they're looking to re-enter the market, and they're trying to find an exact point. But you've got plenty of vehicles like option overlay ETFs that have yields, we're targeting 7, 8, 9% yields. In floating rate, we could see that immediate demand. Even if they come in and cut rates, which I think many feel that that's likely this year, you still have an attractive 9% yield. And that's where we hear very clearly from institutions and advisors that that's of interest to them.
Yeah, definitely. It seems like investors really want that yield and they want the certainty of that yield. Going to have to leave it there. Really enjoyed this conversation. Of course, our thanks to Anthony Rochte of Morgan Stanley Investment Management. Now coming up, after the BOJ halted its purchases of ETFs, the question now becomes, what are policymakers planning to do with this enormous pile of ETFs? The answer may be next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with the credit ETF market because assets in U.S. credit ETFs, they actually hit an all-time high in the first quarter of 2024. You can see we are nearing $350 billion when it comes to credit ETF assets. It's going to be interesting to see how big this pile does become. But let's switch from bonds to Bitcoin because, of course, we're continuing to track what's going on with the flow show when it comes to the U.S. listed spot Bitcoin ETFs. And for a while, even though with this persistent Grayscale Bitcoin Trust selling, you had the other 9 ETFs offsetting those and actually leading to net inflows. But that dynamic has switched, of course, and we have switched to net outflows as that GBTC pressure continues. But I want to end actually with the Bank of Japan because it wasn't all about the Federal Reserve last week. We also got some news out of the Bank of Japan saying that it won't be adding to its exchange-traded funds holdings. Currently, it holds about $475 billion worth of ETFs. It's not adding to that pile anymore. And Scarlett, the question becomes, what is it going to do with it?
Yeah, well, let's put that question right now to Bloomberg's Rachel Evans, who joins us now from London, an old friend of ETF IQ. Rachel, always good to see you. The Bank of Japan owns about 7% of Japan's stock market through ETFs. What are its various options for exiting some of these holdings?
Yeah, well, it's obviously having to think about those now for the first time in a while. It has many different options to contemplate after its historic hike last week. First of all, it could decide to sell them all at once. This seems to be very unlikely given how much they own and just the destabilizing impact that would have on the market. Or they could choose to keep these ETF holdings in perpetuity. That also seems unlikely, just given that the central banks have typically wanted to scale back and exit these markets as they start to normalize their monetary policy. So that has people thinking about a number of different potential routes for the Bank of Japan. One of those, which seems to me to be the most probable, is that they start to gradually sell down these holdings. There's no talk of that happening as yet, but that seems to be something that might come onto their radars at future monetary policy meetings. But there are still some very creative options that are being bandied about. Some are saying that they could give these ETFs to young adults in Japan to further their stock holdings. Others are saying that they could put them into a new vehicle and kind of list that vehicle for investment. So there's a lot of kind of creative, quirky ideas out there for how the Bank of Japan can deal with this huge stash of ETFs. But my money would probably be on them opting to start selling them down slowly in due course.
Well, Rachel, put this into context for us. The fact that the BOJ, it's not going to add to the pile. And like you said, I mean, it could start to gradually unwind them. What does this mean for markets? How big of a deal is it both for markets and the ETF industry, really?
I think in the short term, people are kind of thinking of this as a pause. Like the ETF buying program is over. There's no unwind immediately happening. But when these do start to be unwound, I think, we saw a taster of just how big the impact could be when the Bank of Japan switched from buying the Nikkei backed ETFs to looking at topics related ETFs just a few years ago. There we saw the Nikkei plunging for multiple days in a row, and we saw a sell-off in some of the most concentrated stocks within the Nikkei UK that got quite bad in some cases. For example, the parent company of Uniqlo fell 14%. So given that those sort of minor adjustments, relatively speaking, have in the past had quite a significant impact on the stock market, when we do see the Bank of Japan unwind its ETF holdings, you can expect to see that ripple through to the market. And I think that is going to be something that everyone is watching quite closely for at future monetary policy meetings.
All right. Well, it is the end of an era, and as you say, certainly a big player here in the Japanese stock market, looking to slowly perhaps wind it down. Bloomberg's Rachel Evans joining us from London. Thank you so much. Now, still ahead on ETF IQ, we celebrate 25 years of the Qs with Brian McCormack of Invesco. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence. He's back with us now for today's drill down, where we focus on one ETF. Eric, hit it.
Katie, today we have an ETF that needs no introduction. QQQ, or the Qs as we call it. Look, if you were making a Mount Rushmore of ETFs, I think this one would be on it. It's a legend. It came out in 1999. It basically tracks the 100 biggest stocks that list on the NASDAQ that are non-financial. So what you get is about 50% tech stocks, but you get some other sectors in there. It's not just the tech fund. You can see here, it came out in 99, right before it came out, and then boom, went down a lot and has come back a lot since. 20 basis points, very popular value proposition, considering how much it's up. And look at the holdings here. This is basically a who's who of the best companies really on planet Earth, let alone America. Microsoft, Apple, NVIDIA, Amazon, Meta, Broadcom, Google, Costco, Tesla. Basically, you've got the Magnificent Seven all kind of crunched in there and consolidated. 40% of this is the Mag 7. If you look at the S&P, it's 30%. And that little edge has given it lift over basically everything. Let's look at the return of this versus SPY. I also threw in small caps just to see how much they've gotten obliterated. And then we've got value stocks here. That's growth stocks. And this is the biggest growth fund in America, the Capital Group Fund. This is 10 years. The Q's just, 443%. Double most of these. The best one really is the growth fund. So it's even demolishing growth. And that's why it's got hundreds of billions of dollars, Katie, and is the legend that it is.
All right, Eric, thank you. And joining us now to talk about this ETF, we have Ryan McCormack. He is Senior Factor and Core Equity Strategist over at Invesco, joining us on set. So, Ryan, first off, happy birthday to the Qs, 25. It's quite an accomplishment. And the Qs are fascinating. They've been around since 1999. And at this point, it feels like they are just systemically important to how this market actually functions in the modern day. But when did it start becoming that so important, sort of systemically important tool?
I think right off the bat, back in 1999 into 2000, I mean, it arrived with much fanfare, right? I mean, it was kind of the early days of exchange-traded products, and providing access to the NASDAQ 100, I think, was exciting to investors 25 years ago. And then I think as we progressed through the early 2000s into the early 2010s, we kind of saw, just how much these technologically oriented names started to diversify their business lines. We really started to see the success ramp up. And then even just pre-COVID, we saw a little bit of interest, and then it really started ballooning in 2020 into 2021 and since then. So I think it's been important for all 25 years, and in terms of investor usage, that's kind of grown over that time frame.
So let's talk about usage and how that's changed what your offerings, because QQQ as a 25-year-old is a young adult, but it's also a young parent. It's got all these different offsprings, including
young.
Yeah, exactly, including QQQM, which is some would just say a cheaper version of the Qs, and QQQE. Talk through which has been generated the most interest.
Yeah, so I think off the bat, QQQM, right? We're just shy of $23 billion as of this morning. But you're right, it also tracks the NASDAQ 100. Now, in 25 years, the ETF ecosystem has changed quite a bit, right? What you can do within the wrapper, the types of strategies that are offered. And QQQM is an open-ended ETF versus QQQ, much like, SPY as a unit trust. So we think that there may be some advantages within the open-end ETF format. in addition to the 5 basis points reduction in expense ratio. And we've really, I think, kind of done a good job with the halo effect that we've seen from Qs. I mean, the notoriety, just the investor familiarity. People want exposure to the NASDAQ 100. And if we can do it in a more efficient manner, which ultimately we hope over the longer term will lead to excess performance, that really drove the decision for QQQM. And almost off the bat, we saw pretty immediate interest.
Now let's talk about the index, okay? And our team has really debated a lot. What makes this index so special? It's not beta, it's not growth really, it's not tech. It's hard to define what it is. My thesis is the Steve Jobs thesis, which is once Steve Jobs had Apple list there, it just became the cool place to list for tech visionary types, and it's just kind of gone on ever since. Is that really the bottom line? It just, ever since Apple listed there, it's just everyone's followed suit who's like of that kind of mentality?
I think it's a big part of it, right? Sort of the company that you keep. And NASDAQ kind of establishing itself as the first electronic exchange, I think you saw a lot of these technologically oriented companies and leaders gravitating towards NASDAQ. So I think that was certainly a really important factor in not only some of the larger companies that listed, but over the past 25 years, the types of companies that have decided to move to NASDAQ.
Well, when you look at the broader Q's family suite, like Scarlett said, it's a young parent. And in addition to QQQM, there's also QQQJ, which I find really interesting. That's sort of the next generation of the NASDAQ 100. Sort of, I've always thought about it as the companies that will graduate to being in the NASDAQ 100. And I mean, sort of going off what Eric was doing, marveling at this index, it's amazing that the Qs have even crushed those next-gen growthier names.
Yeah, and especially over the past 3.5 years since launch. I mean, this has been a mega cap dominated market, and then a step further, it's been a mega cap growth dominated market. QQQJ for us, it's looking at the next 100 down in the NASDAQ, and with that, I think it's those companies exactly that will graduate into the 100. So as we look back over the course of what would have graduated, right, something like a Netflix, something like a Tesla, getting exposure to those types of companies before they necessarily make it big or get called up to the big leagues or graduate.
All right, Ryan, really enjoyed this conversation. Of course, 25 years of QQQ. Our thanks to Ryan McCormack of Invesco. And if you just can't get enough of ETFs, a reminder, you can listen to Eric and Joel Weber on Trillions, which of course is their podcast that covers the industry. But sadly, that does it for Bloomberg ETF IQ for at least this week. I'm Katie Greifeld along with Scarlett Fu and Eric Balchunas, and this is Bloomberg.